There's a clear pattern hiding in the latest filings from the biggest funds on Wall Street, and it's hard to ignore. I'm talking about the real power players: BlackRock, Vanguard, Fidelity, and JP Morgan. These firms manage more money than most countries' economies, and every quarter, they're legally required to share their trades in a public report called a Form 13F. It's the closest thing to seeing over the shoulder of the smartest money on earth. And right now, those filings are showing something fascinating: a pattern. Across 4 of the biggest asset managers in the world, 7 stocks keep showing up. 7 names that the institutions who shape the market are either buying more of or holding with conviction. So the real question isn't just what they're buying, it's why. What do they see in these companies that most investors overlook? And more importantly, what can an everyday investor, someone like you or me, actually learn from it without just copying their trades? In this video, we're breaking down the 7 stocks the smart money is buying now, straight from their latest filings. We'll unpack the numbers, the story, and what they might mean for your portfolio next. Before we dive into the actual stocks, let's quickly talk about how to read a Form 13F because it's one of the most misunderstood documents in the investing world. Every quarter, large institutional investors like BlackRock, Vanguard, Fidelity, and JP Morgan are required by the SEC to disclose their U.S. stock holdings. These filings show what they own, what they bought more of, and sometimes what they trimmed. But here's the underlying problem: they're delayed. By the time we see them, we're usually looking at data that's about 45 days old. That means these aren't real-time trades. They're more like a snapshot of what happened at the time. Still, that snapshot can be incredibly valuable. When you see multiple trillion-dollar firms increasing their stake in the same company, that's a signal. It tells you where long-term capital is flowing and which businesses these institutions believe can compound over the next 5 or 10 years. The trick is to look for patterns, not chase prices. One fund buying a stock might mean nothing, but when the biggest names on Wall Street all move in the same direction, that's a clue worth paying attention to. So, with that quick framework in mind, let's start with the first major player, Larry Fink's BlackRock, and the stock they've been quietly building a bigger position in. When BlackRock adds to a position, it's worth paying attention. This is a firm that manages more than $10 trillion. Even a small adjustment in their portfolio represents billions moving in one direction. And right now, one of those moves is Amazon. In their most recent Form 13F, Amazon appeared among their biggest position increases. And it's not hard to see why. The company's latest quarter, Q2 2025, showed net sales of $167.7 billion, up 13% year over year. Operating income jumped to $19.2 billion, while net income reached $18.2 billion. What's really driving that growth? 3 engines. First, AWS, the cloud powerhouse, which alone pulled in $30.9 billion in sales, up 17.5% year over year. Second, advertising, which has become one of Amazon's biggest profit machines, turning product searches into ad dollars. And third, the core retail network, which keeps getting faster, cheaper, and more automated. Amazon's trailing 12-month operating cash flow hit an incredible $121.1 billion. That kind of free cash flow generation gives them enormous flexibility. They can reinvest, pay down debt, or expand aggressively into AI and logistics. BlackRock's bet here isn't about short-term gains. It's about owning infrastructure, the digital rails of e-commerce, cloud, and advertising. In a world where every business is moving online, Amazon is still building the highway everyone else drives on. And while BlackRock is leaning into that digital backbone, Vanguard, under Tim Buckley, is betting big on the social media platform that turned attention into one of the most profitable assets in the world. In Vanguard's most recent Form 13F, Meta Platforms showed up among its top buys, and the timing makes sense. In Q2 2025, Meta reported revenue of $47.5 billion, up 22% year over year, and net income of $18.3 billion with an operating margin near 43%. That's a profit machine. But the real story isn't just ad sales, it's transformation. Meta's using AI not only to target ads more effectively, but to rebuild its entire content engine. Reels, Instagram search, and Facebook feeds are all running on smarter recommendation models that keep people scrolling longer. And that means more impressions, more revenue, and better ad pricing. At the same time, Meta is spending big on the next decade. Capital expenditure for 2025 is guided at 66 to 72 billion, most of it going toward AI infrastructure, data centers, chips, and servers. While that scale of investment can spook some investors, long-term funds like Vanguard view it as planting the seeds for the next wave of growth. Vanguard's logic is simple: own the platform that owns human attention and has the balance sheet to fund the AI that will power it. And while Vanguard is leaning into digital attention, Fidelity's Abigail Johnson is buying something completely different. Most of Wall Street's headlines are dominated by tech, but Abigail Johnson's Fidelity is buying something far more tangible: energy. And their growing position in GE Vernova says a lot about where the next big bottleneck might be. The move came just as the company raised its full-year outlook for 2025, guiding revenue toward $36 to $37 billion and free cash flow up to $3.5 billion. Its backlog, essentially future work already booked, climbed by more than $5 billion, and its gas power segment increased its slot reservations from 50 to 55 gigawatts. Those numbers matter because GE Vernova sits at the heart of a global problem. The power grid wasn't built for an AI-driven world. Every new data center, EV charging network, or smart factory needs reliable electricity, and that's exactly what GE Vernova provides through its power generation, electrification, and grid solutions. Fidelity's buy here isn't about chasing hype. It's about owning the picks and shovels of the energy transition, the behind-the-scenes infrastructure that will profit as global electricity demand soars. With improving margins and a cleaner balance sheet after the GE breakup, Vernova now stands as a pure play on modern energy. So, while others bet on what's built in the digital world, Fidelity is betting on the power that keeps it running. And speaking of power, Jamie Dimon's JP Morgan is putting its chips on a different kind of powerhouse, one that's using artificial intelligence to transform how businesses work every single day. And that is Microsoft. JP Morgan is doubling down on the foundation of enterprise technology. Their latest Form 13F shows Microsoft among its top buys, joining Vanguard and Fidelity in doing the same. That overlap is meaningful. When multiple trillion-dollar managers align, it's rarely by accident. Microsoft's numbers for fiscal year 2025 were nothing short of stellar. The company generated revenue of $281.7 billion, up 15% year over year, with net income of $101.8 billion, a 16% increase. In the most recent quarter alone, Azure grew 39%, helping Microsoft Cloud hit $46.7 billion in sales. Those are staggering figures for a company already at a global scale. Microsoft isn't just an AI story. It's a recurring revenue machine. Between Windows, Office 365, LinkedIn, and Azure, the company has built a portfolio that compounds while funding its next growth wave: AI integration. Tools like Copilot are being woven directly into Word, Excel, and Teams, turning AI from a buzzword into a subscription line item. Financially, Microsoft's balance sheet is a fortress: tens of billions in cash, minimal net debt, and huge free cash flow to keep rewarding shareholders. For Dimon and JP Morgan, that means stability plus innovation, exactly the blend long-term capital loves. And now that we've seen how the Big Four institutions are positioning individually, let's look at what happens when their playbooks start to match on multiple stocks. The crossover stocks that everyone seems to be buying at once. When BlackRock, Vanguard, Fidelity, and JP Morgan all increase their position in the same company during the same quarter, that's not a coincidence. That's a convergence. And right now, that convergence is NVIDIA. NVIDIA isn't just any chip maker. It's the engine room of artificial intelligence. In its latest quarter, Q2 of fiscal 2026, the company reported revenue of $46.7 billion, up 56% year over year. Data center sales alone hit $41.1 billion, driven by overwhelming demand for AI training and inference chips. Even more impressive, NVIDIA guided the next quarter's revenue to $54 billion, a number most companies don't reach in a year. The company's gross margin sits north of 72%, and it continues to print cash, funding massive share buybacks, over $24 billion returned to shareholders in just the first half of the year. That's almost unheard of for a hardware company. But the real reason smart money keeps buying isn't just earnings growth, it's dominance. NVIDIA owns the full AI stack: the chips, the software, and the ecosystem. every major AI model, from ChatGPT to Gemini to Claude, trains on NVIDIA hardware. They've become the toll collector of the AI revolution. Still, NVIDIA doesn't stand alone. There's another semiconductor giant playing a quieter but equally critical role in the AI boom, one that's printing billions while staying under the radar. While NVIDIA gets all the spotlight, Broadcom is becoming one of the biggest beneficiaries of the AI boom, and smart money knows it. It's one of the few names held across all four major institutional portfolios. In its latest quarter, Q3 fiscal 2025, Broadcom posted revenue of $16 billion, up 22% year over year. What's more impressive is the composition of that revenue. AI semiconductor sales hit $5.2 billion, growing 63% in just 1 year. The company guided the next quarter to around $17.4 billion, with AI revenue expected to climb even higher. Profitability? Outstanding. Broadcom reported adjusted EBITDA of $10.7 billion, roughly 2/3 of every dollar it earns, and generated $7 billion in free cash flow. That's the kind of efficiency that portfolio managers love: growth without volatility. But here's what makes Broadcom unique: it's not just chips. After acquiring VMware, Broadcom now owns a massive enterprise software business that generates recurring revenue and huge margins. That combination of high-growth AI hardware and steady software income creates a rare balance of innovation and stability. In other words, Broadcom is the connective tissue of modern computing, the unseen backbone of data movement, cloud networking, and enterprise software. While NVIDIA builds the brains of AI, Broadcom builds the nervous system that connects them all. And just like any living system, that nervous system needs a body: the massive infrastructure that manufactures the chips powering this revolution. Every revolution needs a factory, and for the AI era, that factory is Taiwan Semiconductor Manufacturing Company, better known as TSMC. While companies like NVIDIA and Broadcom design the chips, TSMC is the one actually building them, and that's why smart money made it one of its top buys last quarter. When you look at the numbers, the conviction makes sense. In Q2 2025, TSMC reported revenue of $30 billion and $70 million, up 44% year over year, with a gross margin of nearly 59% and net income of roughly $13.5 billion. Here's the key metric: advanced nodes, chips made at 7 nanometers or smaller, accounted for 74% of wafer revenue. These are the chips that power AI, smartphones, and cloud data centers. No other foundry on Earth comes close to TSMC's precision, scale, or yield rates. That's why even the biggest companies in the world, Apple, NVIDIA, AMD, and now many AI startups, all rely on them. TSMC is the literal bottleneck of progress in modern computing. Financially, the business remains a cash generation powerhouse, with double-digit operating margins, strong free cash flow, and one of the cleanest balance sheets in global manufacturing. And unlike the speculative AI names, TSMC sells shovels in a gold rush, providing the infrastructure that makes everyone else's growth possible. When you look across these 7 stocks, you can connect the dots. NVIDIA, Broadcom, and TSMC are building the hardware for artificial intelligence. Microsoft, Meta, and Amazon are creating the platforms that run on top of that hardware. But there's one piece holding it all together: the energy infrastructure that keeps the entire digital world alive. That's where GE Vernova comes back into focus. It's a classic picks and shovels play, the invisible foundation beneath every major technological wave. So, what can an everyday investor actually do with all this information? First, don't treat these filings as a shopping list. By the time the Form 13F data comes out, the institutions have already made their moves. Instead, use it as a compass, not a GPS. Look for direction, not precision. When multiple trillion-dollar firms are increasing their stakes in the same group of companies, especially ones with strong balance sheets, rising cash flows, and durable competitive advantages, that's a sign of where confidence is heading. Second, think in themes, not tickers. The smart money isn't just betting on 7 random names. They're building exposure across 3 massive trends: AI infrastructure, digital platforms, and energy transformation. You don't have to own all 7 stocks to benefit. ETFs, diversified portfolios, or even fractional shares can give you a piece of the trend without taking concentrated risk. And finally, play the long game. The people filing these reports aren't trading headlines. They're investing for years, sometimes decades. Want to know the 4 patterns that always show up before every major crash in the last 500 years and how they're appearing again right now? Click the video on screen to see for yourself.